Exit Planning Institute is a group that puts out a study. It's called the State of Owner Readiness. And about 75% of business owners want to sell in the next 10 years. It's in the trillions of enterprise value of businesses in the US. And if you look at just the baby boomer group, which the youngest of them I think is about 62, there's about 60% of those that want to transfer in 5 years. So exit planning is just good business planning at its core. The earlier you start, the more opportunities are available and more strategies exist to help you get to the exit that you want. More than 5 years is great. And then as you get 2, 3 years out, you really have the opportunity then to solidify the management team and reduce your owner dependency and prepare to go to market, get your financials in order to go do a successful exit.
Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham, here with Eric Wymore and Ethan Hutchison, as well as two guests today from a company called Planned Exit Partners. So we have Tim Hosie and Stephen Hilborn. So how's everybody doing?
We're good.
Doing great.
Good.
Great.
So, well, I know like in our, I guess for our client base, we have a lot of clients that own businesses. And luckily, Eric was introduced to you guys through a mutual friend a while back. And you guys own a company that basically helps people that own businesses exit at some time in the future. And I think this is a really good conversation for us to have, you know, for our clients to kind of get some information on that. So I guess to start with, maybe you guys can just give us a general overview on Planned Exit Partners. Why'd you start it? What services you provide, and why it would be important for our clients to know who you are.
Yeah, it sounds great. Thanks, Jeb, and thanks, Ethan and Eric, for having us. So I started Planned Exit Partners about a year ago. The idea was that we, as M&A advisors, could be providing greater value to business owner clients by transferring knowledge of what makes a business transferable or transitionable much earlier in the business owner lifecycle, and giving them actionable knowledge, basically, that can basically make more informed strategic decisions so that they can improve the value of the organization, they can utilize it as a asset to generate wealth, and ultimately they can transfer their organization in a manner that they feel both protects their legacy, meets their financial objectives, and meets the objectives of the organization itself.
And so, you know, this is always the big question, you know, when you're a business and you're busy working in your business and growing it, and at some point, you know, father time kind of catches up with you a little bit, and you're figuring out, hey, maybe this isn't something that I'm going to be able to do for the rest of my life. So I guess that's the time to start having those discussions with a strategy or with a group like you. I mean, when is it a good time, you know, for a business to start just the general conversation about some kind of an exit strategy?
Yeah, no, I think that's a great way to put it, and thank you guys for having us on. Really, exit planning is just good business planning at its core. So the earlier you start, the more opportunities are available and more strategies exist to help you get to the exit that you want and meet all those objectives that you might have. And those objectives are typically going to be both personal. What am I going to do after the business is sold? What does my family expect from me? What am I going to devote my time to, and what makes me passionate after I leave the business that I built for potentially decades? And then there's obviously financial elements, you know, what cash proceeds do I need from the sale, and legacy goals, like Tim mentioned, what you want the organization to look like and who you want it to go to. And so to your point, Eric, the sooner you start planning, the more options and the more value you can create over time. And so we kind of look at it as, you know, the best time is going to be, you know, ideally more than 5 years out. And in that time period, you can really start to educate on the exit pathways that exist, whether that's a third party sale, an ESOP, a management transfer, whatever it may be, whichever pathway suits you, and figure out what's right for you. And then start to assess your value map the market for who your buyers might be, and identify the value opportunities and stumbling blocks that you might have if you tried to go to market. And then, as you guys know, there's a ton of tax and structuring opportunities you can do, but you need time to do all of those. Not to go down rabbit holes on each of them, but more time is typically better with planning for the tax burden that you'll have at sale. And so then, we recommend more than 5 years is great. And then as you get 2, 3 years out, you really have the opportunity then to try to solidify the management team and reduce your owner dependency and prepare to go to market, get your financials in order, get the house ready, so to speak, to go do a successful exit.
I feel like there's a lot of businesses out there right now, even that are kind of in that stage where they're just, what's, is there a number or anything like that that you can, is there a number of businesses? It just feels like there's a lot of them that are ready to sell, or at least interested in doing
Yeah.
that.
Yeah, you're absolutely right. There's Exit Planning Institute is a group that puts out a study. It's called the State of Owner Readiness, and about 75% of business owners want to sell in the next 10 years. It's in the trillions of enterprise value of businesses in the U.S. And if you look at just the baby boomer group, which the youngest of them I think is about 62, or will be 62 this year, there's about 60% of those that want to transfer in 5 years. So I mean, there's a wave of folks that are thinking about this. I think it's just and I think that study also says like about 80% of business owners are know that a strategic exit strategy is important, but they are too busy or they don't know where to start is usually what the reason is. And we get that. I mean, we run businesses and it's hard. So you're absolutely right there. There's a big wave and a lot of owners thinking about this.
Stephen and Tim, when we sit down with clients and we think about, or they're thinking about selling the business, they're literally thinking about just taking that business, producing a cash transaction, and then giving that business to somebody else. So what other options are out there that are kind of off catalog that we might not be thinking about, or that business owner might not be thinking about?
Yeah, it's a great question. Obviously, the easiest one to think about is just a third party sale. It's typically clean. You typically run a process, a competitive auction process, but there's obviously other ways in which you can transfer ownership in that company, and a couple might include ESOPs, management buyouts if you have got a strong leadership team, or we also know, especially in the Kansas City area, there's a number that are going to transfer to the next generation or to a sibling or somebody within the family. And a lot of that just it comes down to time for each of those three options. And I'll let Steven touch on the ESOPs in a second. But if you think about the management buyout and the family transfers, what you want to try and plan for is the time component of that transaction, understanding that the individuals that are going to be acquiring the company, acquiring the equity ownership of that company, may not have the sufficient capital to do all that in a transaction immediately at closing. It'll be done over a series of payments, whether that's an installment sale or seller financing or whatever it may be. And that typically just requires time, and therefore then payments made over a period of time. And in any instance, we always recommend that you should consider that not all of the cash or all of the transaction proceeds will be paid at closing. It's going to happen over a period of time because structure is just as important as the valuation itself. But payments are typically made over a number of years, regardless of whatever exit option you ultimately choose. But probably Stephen would probably be best to talk about ESOPs.
Yeah, no, ESOPs are a unique exit pathway. Essentially, the company sells stock to a trust, and that trust divvies out beneficial ownership to employees over time. But like Tim said, you don't get all your proceeds up front in an ESOP transaction. You get a portion of it, and it's really based on the company's future performance to repay the seller. But folks, look at that pathway because there's tax advantages to it, both income tax for the business and capital gains tax for the seller. And it can be a way to continue the legacy and have a slower transition period for owners. So it's becoming more popular. It's been around since the 70s, but it's definitely becoming more and more popular.
So we talked a little bit about this when you were in the office, when you guys were in the office, and Stephen, you kind of touched on this. As far as ESOPs, like, can you identify what companies would be like prime and ideal for an ESOP? But whether it's industry or just like a certain growth trajectory, or what kind of company makes the most sense to go down that path?
Yeah, no, great question. Really, to make an ESOP successful, you have to have a minimum level of employees. It's typically 15 to 20. Once you cross that threshold, you can meet some of the testing requirements. But a lot of times, you look around town, especially in Kansas City, a lot of the construction, engineering, architecture firms are going that pathway. And that's for a bunch of different reasons, but they have, really talented either, laborers or architecture professionals or engineers. And a lot of times they want to keep that continuity and preserve the employee workforce. And it's really geared for any industry that has the level of payroll and has the consistency in earnings. Um, you know, Subject to you being able to meet any
Mhm.
kind of regulatory requirements. It's a good exit pathway for a lot of businesses.
Nice.
Can I also add that just across the exit options, the what makes a business transitionable or transferable are all the same. It's strong leadership. It's an understanding of your future cash flows. It's all the things that ultimately drive future risk. And if we can assess the risk today and make changes that ultimately reduce that risk, the business, regardless of whether you're going to sell, regardless of whether you're going to go transfer it to an ESOP, regardless of whether you're going to transfer it to your management team or to your family, ultimately the value that you can be provided as through the liquidation event, whether it's a sale or again management transfer, family succession, it ultimately relies on the ability for the company to project and see future cash flow, which is ultimately going to pay down debt. It's ultimately pay down seller financing, or it's ultimately pay some form of earnout. And so, as we think about planning specifically for exits, you've got to, regardless of whether you make the decision to sell today or transfer tomorrow or do an ESOP in 5 years, if you make steps that are ultimately driving towards reducing risk associated with financial reporting, key man risk, and customer concentration, you're going to be taking a step to improve the value of your organization in any strategy towards whatever exit you're trying to achieve.
That's good info.
Cool.
Hey, real quick. So, and I do think one other thing that our clients would probably like to hear, because I think everyone talks about private equity now. Like we have business owners, and I feel like everybody knows somebody that's either sold out to private equity or is talking to private equity. Can you briefly, and I know this is a little off script, but talk a little bit about their role in your business and like kind of what you're seeing in that landscape?
Yeah, private equity is a very broad term, right? So generally speaking, it's anything that's not public. So a high net worth individual could be considered a private equity. Family offices could be considered private equity, or you've got what you're probably referencing, which is your traditional fund. And
Right.
even within those traditional funds, you've got lower middle market, excessively large billions and billions dollars funds. But primarily, if you think about where the business owners in the Kansas City region or Midwest region are generally going to be interacting with, it's going to be private equity groups that are in the lower middle market or the strategic company, like portfolio companies of those private equity groups. And so, in most instances, when you have interactions, whether it's a direct outreach, an email, or a phone call, or a personal email, or something like that, or you have a buddy that introduces you to a friend who's in private equity, what you're going to be dealing with is a private equity group that's got a 10-year fund cycle with 250 million of committed capital, and they've got an active thesis or an interest in the space that you play, and they're exploring whether or not your business would be a fit for what they're already doing with their platform company, or would it be a fit for a new investment into that space.
Gotcha. And that typically is more of a premium, right? Like I feel like that's why a lot of people are selling to private equity right now, and why they're active is because they feel like typically they're getting higher multiples in that space. Is that true?
Yeah, as you think about who's got capital to deploy, it's the private equity funds. Like their sole purpose is to generate a return on the funds that have been invested by their limited partners, and they do that via making investments in um, different private companies. And so, yeah, they are typically able to pay a higher multiple, particularly if they've already got a strategic investment in the space, because there tends to be less risk. And as you think about, if you're either the platform or you're an individual bolt-on to that strategic, they've got some debt already in place, and therefore the capacity to do a transaction. They've got a management team in place, which reduces the risk and a thesis around where they want to take the growth. They've got projections and a good financial team that ultimately understands where the business is headed, both from a margin and a growth perspective. And so all these things that tend to be present from a risk perspective with smaller companies tends to be solved if you work with a strategic group that is backed by some form of private capital. It could be, again, it could be a family office or an independent sponsor or something like that as well. But generally speaking, you're able to solve a lot of the risk by combining two strategic entities, and the private equity group is the one typically controlling and making the investment for the strategic party.
Yeah. And then, I mean, multiples are the name of the game, right? I mean, that's what you're trying to do is expand them. And you've kind of given some strategies, or how to help expand it, keep your key man, keep your employees, diversify your business contracts or so on, make sure they're not concentrated in one area. Can you give us a couple of maybe other things that you guys do, or what are we talking about as far as if a business owner engages with you 5 years from now, or they're planning on selling their business within 5 years, and they've got a multiple of X, and then if they go through your talking with you, changing up some of these things, what kind of multiples what are we moving towards? I know it's kind of a loaded question, but like maybe a general idea of what we're talking about.
Yeah, I can just give a brief example, and then Tim, feel free to jump in too. If we met with a business owner, they're 5 years out, what we would do is we would kind of go perform an initial evaluation for the company, and then go out to the market and understand what buyers are looking for in that space. So just a generalized example, but say for a specific market that you're in, private equity buyers are looking for a business that only has 30% exposure to project-based work, for example. And so the company may be at 40 or 50% exposure to project-based work, or insert whatever less desirable attribute you want in that space. And so what we could do is bring that feedback back to the seller and try to understand what are ways that we can either pursue additional contracts that aren't in that undesirable segment, or try to diversify the business in a new way to make the business more attractive. Because I mean, the truth is in the details with what the buyers want. They have a type that they're looking for, typically by industry, and there's value drivers. And sometimes the owners just aren't aware fully of what those are. And so we can help guide them because we've talked to the real buyers in that space. Um, there's a bunch of other options I would think on the business's structure. Tim, I don't know if you want to speak to some of that.
Yeah, again, it goes back to those three risks that we mentioned earlier, which is the key man risk, the customer concentration, and financial reporting. And driving towards a higher multiple ultimately means solving for some form of those risks. We tend to start with the financial reporting because in order to make good decisions, you need to have an understanding of where you're at currently and what kind of cash flow you're generating. What kind of cash flow you're generating ultimately supports what kind of debt can be placed on the business in the future, or what type of cash flow can be used to reinvest in the organization to fund future growth. You think about key person risk or key man risk, you've got an owner dependency issue, typically with smaller companies. And what you can start to solve for is by documenting those processes, and understanding what responsibilities that individual is currently doing, and then either identify a succession plan internally with key management or personnel that can take certain tasks or take certain relationships from that owner and start transitioning them over a period of time. Or you then understand that you need to maybe make a hire to replace the owner, and therefore it becomes less of a risk when that owner ultimately decides, hey, you know what, I'm ready to retire. And then lastly, again, it goes back to customer concentration. If you have a customer that represents 20-30% of your revenue, and maybe a higher percentage of your gross margin, if that customer were to leave or have their own financial issues or whatever it may be that ultimately impacts the sales that they're generating for your organization, you're going to have a major change in how you can finance or what your cash flow is from a future standpoint. And so trying to solve for all of those kind of issues or risks ahead of time through effective planning and strategic planning typically drives for higher valuations and, to your point, higher exit multiples. But yeah, there's a number of different ways in which you can value, but the easiest way to understand it is what's a multiple of my EBITDA or cash flow.
Nice. Last question I have. How do our clients engage with you? Is it simple? Reach out to us. We'll get in contact. Go to your website. What's the process?
Yeah, great question. So, yeah, just reach out, whether it's our website, LinkedIn, email, whatever works for you. But we're really here to help and serve and enable. owners to get to the exit that they want, and increase their value along the way. So things that we do with owners, like I said, we do valuation assessments. We also have exit readiness assessments that we've built and discovery checklists that we can go through and really uncover what your business's characteristics are, so that we know if you entered the market today, here are some of the hurdles and roadblocks that you might need to overcome, so we can help you effectively plan for those. Things that we've been working on recently in that exit planning space. So like Tim mentioned, some owners have been looking at, hey, how do I lock down my key management team? Because like Tim said, that will ultimately reduce risk and ideally increase multiples if you have a strong management team. Doing valuation assessments, like I mentioned, and looking at strategic opportunities to increase value, and also value protection and risk management. So that's, thinking about how do we protect protect the value as an owner approaches exit, whether that's through insurance or other risk planning, and helping them document their processes. So we're here, we're ready to help you and help you figure out what the exit process looks like.
Awesome. Well, I tell you, and hopefully over the next few years, we will have some clients that'll exit the business. And I do think, it's fun that to me in our business, I know Eric and Ethan and I have talked about that is, one of the most exciting things is when we've worked with a business owner for the last 15 years and we've watched their business grow, and then they actually get to exit, and they kind of get their check and get into that retirement phase. It's pretty rewarding. And I think, guys like you obviously have a lot of help that you can provide to them to hopefully maximize the value and also just educate themselves, hopefully long before they actually decide to make that final decision. So certainly appreciate Tim and Steven, you guys being on today. This has been super productive, and thank you. And we'll talk to you guys soon. So this is Metcalf Money Moment podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.